Hi, everybody. Sorry we're a couple minutes late, but Colin Nimsz here, PropTechBuzz ambassador. And we also have CEO of Magma, Matthew.
Hi, everyone.
So we're going to talk about today real-world asset tokenization, what we've learned in the last 6 years. If you do a search on YouTube, you'll find Nina, myself, and some other people were talking about this back in 2017, and we're going to see what's happened. Now, myself, I have a background in tokenization, did some of the first funds on tokenization, first securitization vehicles, some of the first real estate, so on and so on. Later, we'll also have Nina as well, Nina Louis-Siller, coming and joining us. And she's got a long background in history. She can tell you about working in the field as a lawyer. And she's now heading up some of the biggest projects and think tanks, lobbying groups on the matter. To start, I do want to say thank you to PropTechBuzz for hosting this, putting this all together. Robbie's been great. Please go over there, join the community, talk about the different things, ask questions. We have a bunch of questions already submitted from there. It's a really nice platform community that's been building very quickly, very short period of time. And I've been there only a couple of months and I really like it. So please click on it, join, get involved. So I'm going to start by throwing it over to Matthew to give a little introduction, what he's been working on, and then we're going to dive right into some of the comments that we had back and forth on LinkedIn, talking about real world asset tokenization. What does that mean? It's a big topic. So,
all right. Thank you, Colin. Thank you for having me. Thank you, PropTechBuzz. Hi, Nina. I see Nina just came in. So yes, I'm the CEO and founder of Magma. It's a real estate platform, say the Web3 platform. That means we allow any owner of a building to create a digital asset in the form of a dynamic NFT, a digital asset that is dynamic. That means it can be updated by the stakeholder during the life cycle of the building. And so we record everything in a building from cold data. What we call cold data are data that don't necessarily move much, such as the title, the land registry, the layouts of the building, the contracts, leases, and all that. And also what we call hot data, which are the flow of people, the energy, pretty much all the life of the building. And we record that into this digital asset, which is a hybrid asset that can also hold other digital assets, such as carbon credits, or other NFTs that represent the equipment and the elements of the building. And so that way we can have an up-to-date operational data room that can serve as a database to the stakeholders to run operation, answer to RFPs, set up energy performance contracts, or do predictive maintenance or recycle parts of the building and so on. I've been working on this project for almost 6 years now. It was originated in Miami as a smart city project, which was awarded the keys of Miami-Dade in 2018. And since then, we've been working on the development of the platform, Magma. And we started the first digital twin token on November 15 in Paris with an office building. And now we are working with several large asset managers to test the platform. And so also I run like a meeting online every month that's called the Real World Asset Conversation. And Colin, you were part of the last ones. That's where we met actually. And we invite people in the field of blockchain to talk about how this new technology is coming to life and how we are going to take real world asset on chain and create this new ways of contracting.
Thank you so much. So Nina is here. I gave a very quick 2-second intro. So Nina, we'd love to hear yourself, what you've been working on, what your focus is. Please take it away.
All right. Yeah, I'm a lawyer in the blockchain Web3 space already for a couple of years. Colin and we met, I think, 2017 or something, or even 2016 already. I have a background in finance. So first of all, I look into the financial regulatory side of things, or now crypto asset regulatory. And lately I turned more into AI. So I've got a number of projects on my desk which are at the intersection of blockchain and AI. And yeah, maybe important for this round here, I was also part of the 3-year expert group at UNIDROIT. UNIDROIT is like the United Nations Association for creating or suggesting model laws. And that group was dedicated to the private law side of things, so to ownership in digital assets and so forth. That what the regulation is currently not touching upon. So I'm also happy to report when it comes to the question of ownership in real world asset represented by tokens. Then Colin and I had already a lot of discussions about this.
Yeah. And thank you for being a last minute addition. I'm very happy you could join. Unfortunately, Anton, some of you may know, was supposed to join, but he had a family emergency and could not be here. Perhaps in a future one, we'll all get together and discuss a little bit more then about the trading side. I'm happy to answer any questions or comment as much as I know about the trading side of things, but that's more of his field. So what I wanted to do is first do a 5-minute recap to kind of bring this world down in size a little bit, because when we talk about real world assets, the biggest problem I see on all the comments is it's just a massive field. Some people think it means stocks. Some people think it means treasuries. Some people think it means cars. And these things differ very drastically in how they work, how they will work. It'd be kind of like saying, hey, paper, what is paper? And it's like, well, it depends more what was written on the paper than what the paper is. So what I want to steer us away from a little bit today is some of the more retail items like cars or chairs or things like that, and a little bit more towards the investment world, particularly in real estate, because that's a bit more background where Matthew and I have as well. Nina also can maybe guide us a little bit on the Mika stuff. You know us a lot, that aspect a lot better than I do. What I'm going to do though is give a very quick, brief background on this to try to catch up anybody in the audience who isn't familiar with it. A 2-minute version of what I usually do in a half an hour. So there's two key aspects or two theories of ownership. You either have bearer, so if you have a euro or 10-euro bill, if you burn it, it's gone. You give it to somebody else, it's gone. Bearer ownership. You then have registry ownership, which is cars, real estate, most investments. They're really determined more based on whose name's on the registry, because that's who's going to get paid out to. Now, there are some minutia in the law, but that's a very quick breakdown of two forms of ownership. Now, when you talk about blockchain, digital ledger, private key, public key, cryptography, it's really all three of those things together that we talk about. It is more of a registry-based ownership, but it comes with a strange history because the first things that it was used for, Bitcoin, Ethereum, some of the tokens, were issued in more of a bearer form. So this has created a very strange background in which we are now applying to a world that has hundreds of years of history. And this makes the conversation a bit interesting and sometimes a bit confusing when somebody jumps in from maybe a technical side versus a legal side or a financial side. And I think that's where a lot of these confusing pieces get mixed together. Now, one other aspect of this is that when you have rights in something, maybe a piece of real estate, and you break them up, it's very difficult to figure out how to break them up. So a lot of times this has been done through some kind of vehicle, an SPV, a trust, some type of documentation in an SPV, but some legal background, some legal structure behind it that makes it able to break up the rights. Because when you talk about, say, real estate, you're not just talking about the rent that's paid, but you're talking about usage rights, taxation rights, liability, if it falls on the building next door, who pays for it. All these things have to be accounted for. So that, Matthew, that kicks off kind of where me and you were talking about this on LinkedIn, which sort of inspired us to move over to this conversation right now, right?
Yes.
What is tokenization of real estate as a real world asset? What does that mean?
Yes, absolutely. So in order to understand why tokenization is happening, I think we have to zoom out a little bit and understand why, all these new models are existing and starting, to come up. Because we are entering a new era where everything is digitized, like almost all our actions are digitized. Everything we do has a digital trace somewhere, and it will serve as a contract to make a contract in the future. So the way we do contract has changed over the years, and during Industrial Revolution, you often have changes in the way we do business, and the way we do business today and tomorrow will be mostly done through computer, talking to one another and gathering information about assets and parties that owns these assets. And that's where tokenization comes in place, because it is the act of creating an instance of an asset in the blockchain space, meaning in a distributed ledger environment where everyone is sharing the information about the asset and the parties that can transact over these assets. So you see here that you will have two worlds living in the same world, where you have the on-chain base of data, and you have the physical assets that live, their life traditionally. So the old way of enforcing rights on an asset was you have a contract and you enforce your right through a judge that will go after the asset to take the asset back, or enforce any kind of penalty over the person who can prove that they have a damage. Now you have a world on-chain where you have the representation of these assets, and you have ways to enforce claims on-chain if you can seize anything of value on-chain, such as coins or tokens or anything of value. And you have the physical assets. So what we were discussing with Colin was like the breaking point between the fact that you need a vehicle to hold the asset and to enforce claims over the asset in the real world, and the blockchain world, where sometimes you cannot have ways to enforce a physical claim over the asset. Let's say you have a physical building and you want to enforce an eviction over a tenant that doesn't pay his rent, right? So that cannot be enforced completely on chain. You have to physically go and make that, action of taking the tenant off of the property. But if you have a financial way to enforce it on chain, where you have some of the assets of the tenant on chain and you can seize the money on chain, that's the way to enforce the claim on chain. So that's the dichotomy that you have now, is the physical assets and the old world that as a way to enforce things off-chain in the real world. And now you have all this digital representation of these assets, where you need to create a legal framework where you can enforce your rights over these assets on chain. And that's really the challenge, because it's not only it's a legal challenge, of course, because it needs to be ruled by the legislator, but it's also a technical challenge, because you need to create the tools in order to create this enforceability. So that's the environment that we are in right now. It's very exciting, but it's also very challenging.
Yeah, I mean, I think this conversation also spun out of a little bit more of like some comments about, hey, SPVs are burdensome and difficult. And my view is, I don't know that they are. I've found them actually to be preferred, and rose out of the fact that if you don't have one, there are not clear rules about what can be done with the asset on chain versus off chain. It sounds like this doesn't change. Like you still would need some kind of clear structure in order to put all of the pieces of the property back together. I mean, Nina, have you? Am I talking gibberish, or am I making some sense?
Yeah, you might have lost one or the other in the audience. I'm not sure if everybody know what the term SPV actually stands for, right? So with SPV, we mean a special purpose vehicle that is typically a company that limits the liability to the asset. And that is managed by somebody. And when we tokenize by using SPVs, what is actually in the token is then the claim against the one running the SPV to handle the assets in a certain manner, right? So it's a mere contractual claim. It has nothing to do with true in-rem ownership of the asset. And Mathieu, when I heard you explaining these things, let me just add, ownership is a concept that had been invented by humans, right? It's not a given thing. And so you're actually right. You know, if we could convince legislators to implement a token-based ownership concept, then this would actually be perfectly possible. Absolutely. However, as long as that is not the case, and it is not the case yet, there is no way to really, truly tokenize ownership in a physical, real-world asset. And I think that's a truth that we in the Web3 space need to be more clear about, right? Because we are all so happy with, we are tokenizing real-world assets, and everybody thinks of ownership. But it's actually not the title that we tokenize. It's always a derivative, maybe, so to speak.
Right.
And what obviously works is also to tokenize provenance, evidence of provenance, stuff like that. That works already.
I would move into the investor space on this and saying that even if you did change the laws and did allow tokenization of the actual ownership, the title, it would be very unlikely that this would take off, because most investors don't want full responsibility or ownership responsibilities of the title. You would still need some kind of SPV to limit liability.
And somebody to manage the asset, right?
Somebody to manage, and somebody to tell whether or not it can be sold to somebody else, and somebody to say whether or not it was done incorrectly. One of the things I have in the space is that you get to these ideas that everything will be instituted perfectly. In the end, you still need something or somebody to supervise it in case it's not. And most of the time, over a long enough period of time, almost all of them fail. It's just the way the world works. Things change, new things come up. So there's almost always some kind of supervision element that needs to be accounted for. This a lot of times I think is missed in the discussions.
And also remember that the most real-world assets are not commodities, but they are individual things, right? A car which has been used, there won't be any identical car out there. And that also creates an issue. And property is a perfect example for that as well. There is no such thing as a property that is identical to another one, right? These are all individual. These are all individual items, right? And it's really difficult to create a true market for individual items.
Yeah, it's a concept that I think gets overlooked when we talk about tokenization quite a lot, because most of the time people tend to be thinking about the economic benefit. Really, then you're talking about a real world asset that has been securitized, been changed into some kind of security. The management and ownership of it has been outsourced to some other party. And really, you're just gaining the economic benefits, whether it's in a form of debt or it's in the form of profit in an equity type structure.
Right.
That is why you have these vehicles, in order to create that, to do that, because by nature it's not true. And I think, coming from a legal background myself, and Nina's side, I know we've had a lot of discussions from this before. You come up and you sort of understand the history of why these laws were created and why these structures were created. It was actually in the benefit of the investors and the people that wanted them, so you could limit the liability and responsibilities of the people that own it. It wasn't sort of forced on them. It was more of a benefit. So I think I struggle sometimes in these conversations when it says we have to eliminate the SPVs, and I'm saying, well, but that was created because of the market demand for it, not the other way around.
Yeah, I really love Web3 and blockchain crowd, but they tend to try to reinvent the wheel and ignore the history that has led to developments like this. We actually have somebody in the chat asking a number of questions, Colin. I'm not sure if you want to move that at the end of the discussion.
You know what? We're halfway through. Why don't we start? I have about 5 or 6 that came in also through PropTechBuzz. I'm happy to get to them. But Henry, I think you're actually on here. Joseph, can we get Henry on? Maybe he can ask it directly. Hey, Henry, we can see you.
Hello, everybody. Hey, Nina.
Henry.
How are you? Yeah, I had a lot of questions. I was listening to your discussion, and since I'm also part of this movement of tokenizing real world assets, and especially in emerging economies where I'm based off, and where we see a real use case, we're solving a real challenge with this. First, I wanted to ask about the approach of tokenizing investments, for instance, a real estate asset and parking spot, because last week someone from Paris, he told me that, look, I'm looking to tokenize some parking spots in Paris. There is over 600,000 parking spots, and I was thinking about tokenizing them. The first idea that I had in mind is that the process is the same as tokenizing a real estate or any other asset, right?
Yes.
You open the TV,
Yes.
and then I told him that, yeah.
Well, wait a minute. That's we need to clarify what is being tokenized. The right of use of this parking lot for a specific time, or is it the ownership?
Nice question. Yeah, as far as I understood, it's the revenues, right? The potential of all these parking spots making cash flows, right? So that is an investment.
You can do both, no? Yeah.
A
but
profit
you can,
participation.
Yeah, I think you can do both. But basically, yes, you would have to do an SPV, because you cannot tokenize the real estate itself. You would have to create an SPV. Although I think
the real estate itself in this instance, anyways.
But for a profit participation, you don't need an SPV.
No.
But for
a mere profit participation, you do not need an SPV.
Correct.
You know, any company can hand out a profit participation right.
Let me back up.
A company for me is an SPV. A company, and it has to be a company.
Let me back up. Something has to own the spots, and it can issue the profit participation.
Exactly.
So there has to be a corporate or some kind of entity
corporate structure. Exactly.
Somewhere. Right. You don't need to have a specific SPV to issue the security. but
Right.
the company that owns it would need to issue the security. So somewhere there does need to be some kind of
Yes.
corporate structure.
It could
Yes.
be a housing company, for
Absolutely.
example, or it could be a supermarket.
Yeah,
Yes, absolutely.
correct.
And for us, we take a cutting edge approach to tokenizing real estate by using as a digital asset that represents the real estate a digital twin. So for every property that we tokenize, we create a digital representation of it, like pretty much like what you see in my background here. If I can show you here from the studio.
And
I
Mathieu,
can
what
show you.
exactly
Yes.
is it representing?
It is representing the building itself. So
What does that mean?
that means that what you see here is a digital twin of a building. So you have a digital representation of the building that most of the time these digital twins are used for the conception phase or the construction phase.
It's an information. It's
Information twin.
okay.
It's a digital representation. So you have all the elements of the building, and we divided the building in 5 layers, and each layer corresponds to elements of the building. The first layer is a database. It's the data room of the building. It's a contractual layer where you find the proof of the building, anything that can prove what it is, in what state it is, is it conform, what's the yield, the land registry, the title, all the documentation. And then we divide it by elements. So you have the structural elements, the architectural elements, mechanical, electrical, and plumbing, and the furniture. And so each time we will record everything that happens in the building, but we'll also have a visual representation, an intuitive representation of the asset. And so now that serves as the informational base for tokenizing the assets. Everything that is done is being recorded as the life cycle of the building goes. So that's the approach we take to tokenizing real estate.
Okay.
Because it gives transparency to the, let's say you are an investor and you want to invest in a project, you buy the token on the market, and you can, if you have Magma added to that, you can see where the money is going, what are the stakeholders involved, who is managing the project, is the timeline, on time, etc., etc. So you have full transparency on the investment, and also it's very useful for the stakeholder for transparency and for operational management. And you can create smart contract with all this data.
It's not the rights though. It's just the informational
Yeah,
basis.
it's an informational base. Absolutely. You still need the SPV above.
So the token gives you access to information about the property.
Correct.
Okay.
Correct.
Okay. So Henry, I mean, thank you for the question. I think we covered it a little bit. Do you have any follow-ups? Otherwise, I'd let you go and jump to some of the other ones.
I have another follow-up question, and it relates mostly about the investor side. So it's one thing of having assets ready to be tokenized, right, to be digitized, and it's another thing of having the other counterparty, the investors that are ready to participate in these assets in one type of or form. And my question is related in what can be like the actual appetite of investors that want to be on board, want to use tokenization as a way to invest into real world assets. And with what what are the preferred jurisdictions of these people to form, let's say, in my case, our assets are all in Albania and in Balkans, but we know for sure that investors who are in these rails, they would be more safer to have the legal structure somewhere in Europe, like Luxembourg or Switzerland. And the question basically deals with where is the preferred jurisdiction for investors, where are they safe to invest in real world assets, and how much is the appetite for them to move and to acquire these properties and to manage their portfolios into this infrastructure.
I'm going to wrap this into another question we actually had that came through PropTechBuzz as well. So Jim also asked, can you share some success stories on tokenization of real world assets in practice and price stability, volatility, because it all kind of corresponds with investor appetite and risk for this type of thing. And then Henry, I'll let you go, and Joseph can move you back out. It depends, like anything else. So if your investors are going to be in Germany and it's a German property, why would you go anywhere else? Stay in Germany and you can attack them, although maybe Nina has some other ideas on that. If you're talking about funds, Ireland and Luxembourg handle, what, 90% of the alternative funds market and in Europe. So you're talking about really those two jurisdictions are handling most of it. In the end, different investors have different preferences. You need to really know who your market is and what you're going to do in order to meet the investors where they are. Most investors don't care a lot about whether or not the thing you're doing is tokenized. They care about what the underlying investment is. Is it safe? Do they understand it? And these are all challenges that still need to be dealt with a lot in the tokenized world, real world assets. But Nina, you've done a lot of other projects in other jurisdictions as well. I'd love to hear some of your thoughts on it.
Yeah, I think the one thing to consider is always that a real world asset is always under the jurisdiction of its location. So you cannot like transfer a title in an Albanian real estate according to German law, right? That won't work. So somehow even if you move into another jurisdiction that is maybe seen as a little bit safer by the investors, you will need to deal somehow with the legal framework in the jurisdiction where that real world asset is physically located. And that makes it really funny when you deal with movable items, like cars, for example. Because when a car crosses a border to another nation state, it immediately falls with regard to transferring the title in that thing to that other state. And that is something that on a technical level and with having a global market in mind, it's nearly impossible to deal with. And there again, this is again, an argument for using SPVs, because these SPVs can be located somewhere, and then you have the touch point with the SPV, right? So I agree, Luxembourg, Ireland for funds, but maybe, Colin, you need to explain why are you talking about alternative funds in this context? I think that's maybe not immediately understandable for everybody.
Yeah, so my specialty and background on this topic really focuses a lot on securitization vehicles and the alternative fund world. And that world for Europe generally sits in Ireland and Luxembourg. Why? They have a lot of expertise. The structures are very well laid out, and they have built in a lot of tax advantages from being there. So there are
and maybe, Colin, maybe what's missing is securitizing assets, as you just described it. It's basically doing exactly what everybody in the Web3 world is calling tokenizing, right?
Yes.
So basically, when you look into the traditional finance industry, that stuff is called securitizing, right? Yes. And the only difference is that you're attaching a token now to it. Hence,
I would actually say it's even simpler than that. And I think part of the problem with these discussions are exactly what you pointed out, that we already have words for this, and it gets very confusing because the tokenization Web3 world is using new words to say the same thing that a lot of these old world words already said, like securitization. And you're not even attaching a token to it, because a token is actually not a thing really either. All you're doing is using a blockchain registry to register the security, which is the same thing you did before. You just used Excel or Clearstream or some other software. So one of the things that comes up in a lot of my discussions are, do you even need a lot of the infrastructure that Web3 says you need for tokenization and wallets and all this other stuff, because it's really a bunch of words representing the same thing that we already did before. And as you add those words, you also now add confusion for the regulator, in which case you see these new laws now coming out based off of Web3, when most of the time I've got my projects approved, it's because we were doing the same thing as before and we use the same language as before, even though it meant tokenizing a fund or tokenizing a piece of real estate or doing something else in the tokenization world. That's why we were able to do it first, because what are you really talking about? Registry-based ownership. That's
I think
it.
The opportunity here, I think, would be that for the first time, we have an opportunity to have a universal language for securitization. And Web3 is really about getting a standardization of these processes, which in the end are the same in the countries where you have to see in Europe, 75% or 80%, I think, of the local laws in countries derive from the European jurisdictions. So that means, and they are very similar to the ones in the North America. So I think with Web3,
as the U.S. lawyer,
the protection. In the end, what you want is to protect the investment and to enforce claims, right, on the asset. When you talk about securitization, you take a stock in France or a stock in the US, it's mostly the same rules, right?
The theories are similar. When you talk to two lawyers from two different places, obviously,
right? Because I know,
differences.
yeah, it's case law, common law. I get that, but I'm talking about securities. When you talk about securitization of an asset, you end up with the same thing. You want to protect the investors, you want to protect the creators of the company, and you want to enforce claims over these assets, right? It's mostly the same goals that we all have, you know. So I think with Web3 is the opportunity to sort of universalize these laws into this new, web computers that are at least that's my that's my ambition. That's the dream. That's the dream. Exactly. That's what we see in Web3, right? So otherwise it wouldn't be called World Web 3.
And I know I'm always the spoil sport, but that's not how it works. Right? The way it works is we have the United Nations Charter, which enables each and every country to determine within its geographic boundaries the rules at play, right? And you won't overcome this United Nations Charter with Web3. So you will need to deal always.
Why not? Why not? Why can it change?
Oh, it can change. It certainly. If you find an agreement on a global level between the nation states, then it can. But you see, we have tons of international agreements out there, and they take 20 years to come to an agreement. So this is nothing on which basis you should now develop products, because it will not happen anytime soon. So basically, if you want to produce a product now, then you need to deal with the current state of play, right? Which is a splintered legal framework. And personally, when you ask me, I think that's perfectly fine, right? I mean, we have about 200. That's maybe a little bit too much, but actually, law is already decentralized. Right? And it's horrifying for me, the thought that we would have one single global law, which you cannot escape. That's, I think, not a good idea. So I think, we should try to reduce the number of jurisdictions in the globe. And in the EU, you can see that happening, right? 27 states are agreeing more and more on, a legal framework which applies across all the 27. So maybe we can reduce it globally down to 10 or something, but you will always need to deal with more than one jurisdiction. And unfortunately, specifically in the security space, US and Europe are very different, right? So yeah, I have this conversation quite often.
Yeah, I'm more optimistic than I come from a legal background as well. I was, I studied international law, so I know the hurdles and I know the laws that rules, different continents. But I'm more optimistic in the way that I think this blockchain world is more global, and that we have the opportunity to set those rules where business is looking for interoperability and standardization, because what business need is to be able to do cross-border transaction, to be able to deploy businesses over different jurisdictions. And so the way to do that is either you work on the ontology, like you have the same language to design things, like you have, for example, in the aviation space with IATA, where you have one single language for the whole world, and every plane that flies in the world now use the same language thanks to IATA. In the financial world, you have Swift language, where you can send money from a bank to another using the same language. But it's not the case for all the other sectors of the economy. And so what I'm saying is that we could work on something that is more interoperable by working on the infrastructure that are the digital assets. If you say now, instead of working each one with the version of this asset in our softwares, like in a building, you have the property manager, he would have a version of the asset. You would have a service provider, he would have a different version of the asset. And when they want to work together, they notice that they have asymmetry of information, because one thinks this room is 100 square meter, the other thinks it's 90 square meter. And so this is a problem of language or standard, that they are not using this, they are using different systems. So by working on a digital asset that is shared by the parties, and is the same asset, you eliminate a lot of the issues of having silos. And just by defining this same infrastructure globally, you can eliminate a lot of the hurdles of having different ways to name things in different jurisdictions, that leads to a business that is not flowing, seamlessly or flawlessly.
I think we're talking about a couple of broad things. One is information on the asset itself, and the other one is actually the structure of the asset.
The infrastructure, absolutely. That's the two-way, exactly.
Yeah, exactly. Two different things. So one could be more of a secure data room driven by tokenization, so people can maybe rely on the information provided there. It's a different conversation than building a infrastructure for the financial aspects and world, which one of the big things that always kind of gets forgotten or left on the side is the taxation element of whatever happens with the financial tokenization world. Right. I know one of the big things is the transfer laws that are happening. And Nina, I know you've been working pretty closely on that recently as well. But it's a big deal. The world of tokenization seems to think that you can just kind of trade and move private assets or investments all over the place. And the problem is that taxation doesn't work that way. It's not universally accepted. You need to know who owns what, who pays what taxes, when a company needs to withhold money from that particular owner to cover taxes, withholding tax, what they need to hold, where that owner sits, who they are, how they're investing, are they a taxable entity? All this stuff comes into play and gets forgotten. And one of the biggest parts of this is what we hear about AML, KYC, anti-money laundering, and know your customer, know your client. A lot of times that is thought about only for illegal purposes. And what is not thought about is that tax avoidance is an illegal purpose. And that is one of the major aspects of this industry that tends to kind of just be left on the side. But Nina, I know you've been kind of working on this a little bit, and feel free to jump in, go a little bit deeper on this.
Well, that's exactly my point, right? I agree with you, Mathieu, that we can standardize in theory. But in practice, this is really hard work. And I also think you always must be clear who is the one standardizing, right? And typically these are international organizations. It's nearly never a private company doing that, right? And so the question would be, if you want to reach that goal, how are you going to pursue that goal? Through which organization do you want to organize that creation of a standard? And I always tend to say Web3 is team sport, right? You need the technical people, you need the business people to understand the economics behind it. You need accountants, tax, legal, right? So you need all of them to come together. And I'm not advocating for not trying to do this. That's the reason why I had been joining the UNIDROIT working group on digital assets and private law, because I really want to support this development. But I'm pretty sure that everybody who wants to produce a product right now should start with the situation that we are in. And work from there, right? That's the only thing I'm saying. And I completely agree, Colin. There are tons of aspects. It's basically only the technology that works globally. Nearly every other aspect does not work globally. Immediately at once.
Yes, you added the taxation one, because we look at the legal aspect, the technical aspect, and now you have the taxation aspect.
Yeah.
So yeah.
Right.
And accounting. Accounting is also sometimes killing.
You have to be holistic to understand
Exactly. It's team sport.
I'm going to cover a couple of things really, really quickly as well that come up all the time on the same aspect and topic. So AML KYC, sometimes you hear zero knowledge proofs, or, oh, hey, we can just get an approval. The problem is there a practical one of when somebody comes by and asks you to prove that you actually know who your customers are, you don't have any knowledge to report to them to prove it. You don't have any knowledge to report to them that you're actually meeting your taxation liabilities or your laws or your rules. This is complicated stuff that still needs to be worked out, and is very different from the traditional world where you are collecting this data, especially as a private investment. If you move in towards more of the public investment, that's why you have clearinghouses, because that's kind of what they do for you, and that's where they sit. So Clearstream, Euroclear, the DTCC in the US. It's also why you get into why does it take T+2, T+1, T+3 days to complete trades? Technology has been there for decades. I remember talking about this in 2015, that they could do T+0. They actually have practical reasons, not technology reasons, why they don't do it. In certain realms, it's changing. So we're seeing treasuries now being able to be traded a little bit more often. But treasuries are the simplest securities. It's guaranteed by one entity. You know what it is. You can look it up. It's a government entity. There's no real risk of that entity not paying out most of the time. So you're really talking about starting with the simplest ones. This is going a little bit more now into some of the questions about like BlackRock and their funds and how things are moving. But the technology at first will have very minute fractional improvements over the previous tech. As it gets integrated more and more, those improvements theoretically should be borne out and become stronger and stronger and bigger. Who's going to benefit the best from those tiny fractional improvements? Generally, the people that are doing the most of those transactions. Who's doing the most of those transactions? Well, BlackRock, they're the largest in the world. So it makes a lot of sense why, if they could find even the smallest gain, that's where it would start. And there is a lot about the Web3 decentralized world that I worry a bit about. And I worry a bit about it because the technology's most obvious use cases are going to be most beneficial to the largest institutions first. Now, if they move, maybe, we'll see, who knows. But that's where you see the big gains. And some of the things that we've been talking about very deeply is that access, democratization, doesn't necessarily mean liquidity. It doesn't necessarily mean access will actually give you democratization. These are not really, when you look at statistics, don't always work. There generally has to be other factors involved that also have to move it towards that. And I feel like this community has not gone deep enough into understanding all of these different aspects. And it's something I believe in the tech. I believe in what this is doing. I've pushed this technology quite far in Europe. But if you don't understand these other aspects of it, then it's really hard to go to big bodies or regulators and tell them that they don't get what's going on.
They do.
Because they do. Most of them do. And I think it would be really helpful for this industry for people to understand what they're asking to change in the history and the depth behind why things are the way they are a little bit more than just saying it needs to be changed, because it's then hard to take it seriously.
Well, and I even come a little bit maybe from another stance. I really am criticizing the regulation that we currently have, right? I'm not a fan, and I think there are many things that are completely wrong. However, being realistic, try to live with it because you want to, do business now, and then, set aside a little bit spare time to work on getting that changed, right? But to just dream about the world being different from what it is right now doesn't really help. And for us as a community, really, we need to learn to work better together. Right? We had the chance to get the regulation right, but we are so splintered in tribes, and each project tries to work on its own, but we need to collaborate better, right? As a community. Actually, in essence, from a legal perspective, the ETH max and the Bitcoin max, they should be all aligned in getting a proper regulation in place. They would all benefit from that. So that's my invitation. Start to collaborate.
Yeah, I absolutely agree. So I want to get through some of these questions. We only have a couple minutes left because I do appreciate when people go out of their way to ask them. What are some key insights gained from 6 years of real-world asset tokenization? How these insights shape the future trajectory of tokenization in the PropTech industry? I think we basically spent the last 40 minutes or so pretty much covering that one. So please make sure we go back. One of the largest drawbacks of real-world asset tokenization is conferring legal rights on physical property in the same proportion of holding tokens on blockchain. Enforceability of tokens is one of the unsolved legal barriers. Have you witnessed or experienced a solution on this in any country? I think we started with this one. Essentially, you need some kind of legal structure. Otherwise, you won't be able to enforce this, and this is not going to change for decades.
If I can chime on it on a little bit, something that might change here with the enforceability, with the creation of this new digital asset, is now you have a digital asset that you can seize or that you can use as collateral. Before, you just had the physical object and you could enforce it through someone that had custody on it, right? Now, imagine you have a representation of this asset on chain, like an NFT, that holds all the metadata of this asset, and maybe also a digital representation like I showed you earlier. And now you say that from this digital asset, you can run smart contracts, because if you want to pledge this asset, the real one, as collateral, you need to get this NFT in the hand of the lender. So the lender will now use this as collateral instead of using the physical property. And so that's something that might change as well in the way we do business in the future. So
using the digital data twin as a factor of being able to use that as an asset and leveraging that against it, because the legal and actual ownership asset will be something else, but the data on the asset could be very valuable, and that could be possibly leveraged.
Exactly.
Yeah. Okay. Real world assets seen as a gateway for DeFi pools to get invested in traditional assets. What progress have you seen in this domain? How are legal structures evolving? Around the same. In my view, DeFi is really difficult to get into the financial field because of AML KYC problems. Tradability problems are also another issue. Taxation. But Nina, what are your thoughts on this?
I'm not pretty sure what is actually meant by that. So is that, I don't know, most of stuff out there is called DeFi without really being fully decentralized. So a lot of stuff called DeFi is actually centralized application running on a decentralized protocol. And for those, actually, Colin, if they would like to, they could, become AML compliant and invest in things like that, right? But that's also something maybe to keep in mind, that regulation, how it is built right now, is creating like a Chinese wall between the white Web3 world, which is KYC'd, fully identified, regulated, and the black part of it. So the crossing the line between those two worlds will become more difficult with the new regulation kicking in. And that's maybe something to keep in mind.
Maybe also to kick on the KYC AML aspect, there was some progress lately with the ERC 3643 standard. That
the T-Rex one?
The ERC 3643 allows for permission.
Yeah, that's the T-Rex protocol. Yeah.
It's a permission-based protocol for, it's like the same as an ERC, which is permissionless, with the permission through a KYC AML that a financial institution can perform before giving access to the digital asset.
That's a complete new topic now.
Yeah, I was going to say,
I actually need to move on. I need to go on another call. So I wanted to say thank you to both of you. Maybe
thank you, Nina.
Continue a little bit more.
Nice to meet you.
Colin, was great seeing you again. Matthew, nice to meet you.
Nice to meet you.
Thank you so much. And we'll do another one, and I'll let you know. I'll wrap this up, but thank you, Nina.
Bye.
Thank you, Nina.
Yeah, I mean, I read through the whole paper just again this week.
Yes.
There's a practical issue with it still. And practical issue is that as an issuer, I cannot rely on the zero knowledge proof that this is based off of. I actually am required to still know my own customer, which means I still need to collect the data. Even if I get it approved by somebody else, it's my responsibility. And I need to be able to prove that I did it. And simply having a check is not proof enough to a third party. How do I get PwC or somebody else to audit that I have actually done this? How do I get a legal firm to actually show them that it's been done, rather than relying completely on somebody who's unrelated? It's possible that it can work if everybody in the system all sort of agrees, and then we'll pass that information on anyways, but then you're kind of avoiding the entire point, because then you're passing the information on outside of this separately anyways.
So you can keep it as for yourself and just open a zero knowledge proof.
No, you can't, because then the other party has an obligation to show that they've collected it, and a zero knowledge proof does not meet an obligation.
I see. Okay.
Yeah. See, right? It's not about practically does it transfer. It's how do you actually prove it when you are asked about it later on. There are theories. Unfortunately, the paper does not dive deep enough into them. I would love to have it discussed more.
Maybe we can talk about it with Anton.
Because I think there are maybe some ways to make it work, but the paper itself does not go deep enough to understand it or not in a practical level.
That's a good topic for the next one.
Yeah, I agree. Thank you, everybody. We're running late again. Thank you, Ravi and Joseph. I know you're in the background, the PropTechBuzz guys. Please, it's a great community. The more people interact with it, the more we're going to be able to have these. We'll get better topics. We'll know the questions a little bit more. If you want to know where I got the questions from, some of them were presented there. So please sign up, log on, tell us what you want the next one to be about.
All right. Thank you so much, Colin. Thank you, everyone.
Thanks, everybody.
Thank you.